Welcome to the AWA Market Minute, breaking down financial, political, and economic events that impact today's retirees. Our investment committee performs hours of research and market analysis every month so that we can share simple summaries with our clients in 30 minutes or less. Featuring top industry experts who share insights on important topics so that our clients can gain understanding and peace of mind on their journey to and through retirement. And now your hosts, Chief Investment Officer Scott Hoxer and Founder and CEO Paul Coles.
Scott, we're back at it. Another episode of the AWA Market Minute.
Yeah, that was a fast month. I feel like we were just barely here.
We are, and now we're well into fall. As soon as summer came, it went, which makes me sad, but I'm excited about this new season.
Yeah, it's been a fabulous football season. You and I are both fans of pro and college, and been some pretty amazing games.
It's fun. The football is in the air. The cooler weather is starting to begin, and with the cooler weather and that transition, we start to see some beautiful leaves changing, and the landscape up here in Utah could not be prettier in the mountains right now.
Yeah, you and I were at a conference in Park City last week, and the leaves up there were just spectacular.
Absolutely worth the trek out here to Utah for anybody who's not from here. I have a beautiful picture of just above my home. This is a shot that was taken Sunday night. You can see this little drive getting up to the top of this spot here. I took this picture. That's the Salt Lake out in the background there, and Antelope Island off in the distance. Gorgeous leaf changing. And just behind me in this picture is that. that is my daughter's car. My 17-year-old daughter called me up Sunday night in tears and said, "Dad, you're going to kill me." I said, "What on earth is going on?" And she said, I took the car for a drive to go see these beautiful leaves that we've been talking about. And she said, I ended up in a position where I probably shouldn't have been, and I blew out a tire, and I drove on that tire, as you can see here, and the tire shredded. And I said, "Where are you?" And she explained to me that she had taken a drive up above the B. And for those who don't know that area, kind of above the Bountiful Temple, there's this dirt road that is not meant for cars.
I ride my dirt bikes up there.
Yes. Scott and his family take mountain dirt bikes up there. There's ATVs that go up there. There's four-wheelers and side-by-sides. And my daughter didn't understand that a BMW does not belong up this mountain. And she just kept going and going, and there was not a good place to turn around. So she kept going and going and going, and she found herself clear up on top of this mountain. In fact, the spot where she was so high up, I got a little bit anxious just driving our expedition to get to her. So I had to change this tire out up on the top of a mountain. We were lucky enough to be able to get up there and do that. And by the time we got that tire back to the little tire shop there was not much of a tire left. So
she did a thorough job, Paul.
Really?
Yeah.
Really?
I don't think she missed any spots. Yeah.
there's not a tire. There's really not a wheel left anyway. They told us we're gonna have to replace the tire and the wheel. So I love my 17-year-old, and I have to keep reminding myself I was once also 17, Scott.
I've commented to my boys on occasion, Paul, prefrontal cortex, and they're still developing some of that judgment at that age.
It's awesome. We certainly appreciate the having family, and we're grateful for these kids. But every now and again, you have to just remind yourself, their brain is developing, and they'll get there. And at one point in time, we were there as well. So, Well, Scott, I think we've got some good stuff we want to share today regarding kind of some market update stuff. Why don't we kick into gear on that? And let me share a screen here, Scott. You can kind of give us an update on where we're at on the market today.
Yeah, so it's been a solid month as far as markets go. All the major indices are up over the past month. It's not without a little bit of volatility. Last week we had a fair amount of volatility, but overall markets have been up. The Dow's kind of trailing the pack, just modestly up, less than 1%. The S&P's up, knocking on the door of 3%. And then we get into the NASDAQ, and then the highest line you see there is the actual Magnificent Seven. And I don't want to belabor this point because we've talked about it in prior market minutes, but we continue to see markets driven by 7 big tech names. And so valuations for those remain high, and they still continue to move onward and upward. But it does make us a little bit anxious when 7 stocks outperform the market overall by that wide of a margin.
And so these are the 7 in composite, compared to the NASDAQ in its entirety, compared to the Dow in its entirety.
The S&P, yep.
Sorry, the S&P in its entirety, and then the Dow at the bottom down here. So, and then what percentage of the Dow was made up of those 7?
I don't recall off the top of my head. They've kind of crept their way into the Dow, but where it's a price weighted index.
But of the S&P,
yeah.
sorry.
The S&P, I haven't looked at recent metrics, but historically it's been about 30%.
Yeah. So about a third of the S&P, which is pretty wild, and then obviously the NASDAQ, and so we see a huge performance driven by this concentration of positions.
Yep.
Okay.
Yeah, next chart we see is the price to earnings ratios. And so the spike that you see right there is kind of noise. That's the financial crisis when there were no earnings. There were, stocks were still trading, but there were no earnings being generated. So that's statistical noise. But right now we're trading at almost 26 times earnings on the S&P, and that is above normal. It's not, crazily elevated. Prior to the dot-com bubble, that figure was closer to 34 times earnings. So we're not into that territory, but it's certainly elevated right now. But per the earlier chart, it's not a universal high PE ratio. If we look at the Magnificent Seven specifically, their PE ratios are significantly higher than the market overall. And so while the market's expensive right now, it's particularly expensive at the top of the market. And I think it suggests that as investors, we would typically do well to make sure we're not exclusively focusing on those expensive tech names.
Goes back to some of those fundamental principles that we always like to teach, right, regarding diversification and the need for that, not chasing that hot dot.
Yep.
Yeah, which is hard to do in investing. People get caught up in chasing performance, and when we see that, it makes it's hard to not chase that shiny toy.
Yeah. So the $100,000 question kind of on everyone's mind, Paul, is, where do we go from here? Where are markets going? There's no shortage of talking heads, opining, this way or that. We like to look at the economic data, and what the economic data suggests is we're not necessarily looking at a rip-roaring economy, but also a recession isn't necessarily imminent. So if we look at some of these next charts, the first one I wanted to walk us through was the yield curve. And so the yield curve is interest rates for a given duration of time. And so usually interest rates in the future are higher than what they are in the present because a dollar today is worth more than a dollar in the future. So you have to be compensated for those future dollars. And a normal yield curve goes up. It's a curve that goes up over time, where a 30-year rate is going to be higher than a 10-year rate, a 10-year higher than a 5, and a 5 higher than a 6-month rate.
Which is intuitive. That's how it should be.
Yeah, that's how it should be. But if you look at it, we've had, a version of a somewhat inverted yield curve, and this isn't as inverted as it has been historically. But if you look at like 3 and 6 month rates, those are higher than 5-year rates. And historically, that has been a harbinger of potential recession. The challenge with that is we've had inverted yield curves for years now, and we continue to see markets going up. So it's not always a death knell and means recession is imminent, but historically speaking, that's been a pretty good predictor of recession.
And explain to us what causes an inverted yield curve.
So it's kind of complex. It's kind of the deep end of the pool as far as interest rate strategies. But when we do have a recession, we typically see a pullback in interest rates. And so when the rates are lower in the future, it's saying, hey, we're going to have a recession. With said recession, rates will go lower. Therefore, rates in the future should be a little bit lower than what they are in the present.
Okay. So that's why you said it's a potential indicator of economic recession with these inverted yield curves. There's an element of fear towards, what the long-term value of the dollar might be.
Right.
Okay.
Right.
That makes sense.
Yeah. So again, not 100% lock, but it has been a fairly accurate predictor over time. It's just with the last several years, there's been calls for or predictions of recession for an extended period of time that just haven't materialized. Next chart I want to show, I think also speaks to, hey, are we headed into a recession or an economic slowdown? And this is a producer manufacturing index. And so this is showing orders and manufacturing activity. And this is a really good leading indicator. So this is a good, harbinger of, hey, what's going to happen in the future, not necessarily looking in the rear view. And so this is a helpful one. And the level we're looking for with this indicator is 50. So typically if it's above 50, that indicates economic expansion. If it's below 50, that potentially suggests economic contraction. And so you can see it's right near that 50 number. And that's why we're of the opinion, both on the yield curve, this metric and other metrics, where we don't necessarily feel we're headed into recession, but I don't know that we're going to have rip-roaring economic growth. Some of the long-term forecasts are, between 1.5 to low 2s as far as GDP growth, which is economic expansion. It's not contraction like we see in a recession,
right,
but it's probably below the, optimal levels of growth that we would see with our economy.
Right. So glass is kind of half full, maybe. We're not where there's no expectations for anything kind of to explode over the next 12 to 18 months, but there isn't any strong indicator that things are actually moving the wrong direction either.
Yeah, that's kind of where we land.
Yeah. And I think in context of retirement, it's kind of business as usual when it comes to investing our money. This is the hard part, is a lot of times people will want to, get ahead of these indicators and say, how do I react to this in a way that will, put me in a position to have an advantage knowing this information. And there's not a lot of things that we should be acting on today. Not a lot of good indicators that say, take action regarding this information right now. It's kind of business as usual when it comes to long-term investing strategies.
Absolutely, Paul. And investing is a game of playing the percentages, right? And we know the markets are up 3 out of every 4 years on average. And so I think where people get into trouble is they try and read the tea leaves too much and get themselves way directionally committed one way or the other.
Yeah.
And if they miss that bet, they are not playing the right side of those percentages.
That's right. That's right. And it's just not good fiduciary-based best practice principles when it comes to designing a portfolio where you're saying, I am going to be very reactive to every indicator that I see, because you can go zoom out, 100 years and the data is very strong that the best performers are the ones who were very consistent throughout the exercise.
Right.
So one area that we are deeply concerned about, Scott, is kind of watching the overall economy from a perspective of, let's look at it like a household. Let's look at the government like a household, and the government spending and the government's debt as if we were examining just one of our client households, and how would we feel about this client if they showed up to us and said, here are, some of the financials that I've got going on. So this is a pretty interesting slide here.
Yeah. So to use your analogy, Paul, this is the household of the United States of America. And so we currently carry overall debt of about $37 trillion and counting. That's the overall debt. And currently we spend about $7.4 trillion on an annual basis. So $7.4 trillion is going out the door. That's about $1.9 trillion short of what we're taking in tax receipts and other revenues. So we fall short to the tune of almost $2 trillion a year. That $2 trillion has to go somewhere, and that adds to that debt figure every year. So all things being equal, that goes up to $2 trillion, to say nothing of the growth on the back of potential interest. So that's kind of the shakeout there. If we look at that $7.4 trillion, a lot of that on January 1 of every year is already earmarked and is already set to
Yep.
be spent. There's not as much discretionary spending as perhaps some would think, because Medicare and Medicaid consumes about 1.7 trillion of that 7.4, Social Security about 1.5 of that 7.4, defense almost another trillion, and then this is the painful one, about $1 trillion of that goes to service interest.
Just paying the interest on
Yep.
all those debts.
Yep.
Yeah. So I took this exact slide and I broke it down into some cartoon graphics here, just in the interest of making sure everybody understands this information here. So what we see here, same conversation, Scott, about $5.2 trillion. So think about that. That's how much money we bring in every year from our annual tax revenue. So if we were to break this down as a household, that's how much money your wages. So that's about $15,000 of revenue per citizen. So if we take every citizen in this country, that's about how much money per citizen is adding to our wage base. 7.2 trillion, to your point, Scott, was our spending number. So we clearly are overspending the amount by over $2 trillion. And then I break that down just like you did: 1.7 Medicare, Medicaid, 1.5 Social Security, $1 trillion in defense, and another $1 trillion in debt. So there's our $2 trillion deficit. $37 trillion is the total credit card bill today. That's how much money we've got on the credit card. And Andrew, I'm not sure if we can see that bottom part of that slide. Keep going a little bit more. But that shows $323,000 is our debt per taxpayer. And so that's hard to see. $323,000 our debt per taxpayer. And here's the crazy one. It's 2,153% is our ratio. So that would be considered like the debt to income ratio per taxpayer. How wild is that? 2153. So if somebody came in and said, I want to borrow money, but my debt to income ratio per taxpayer is just almost 2,200%. We'd say, yeah, that's probably not the kind of thing that you should be borrowing money for. So that causes us some major heartburn. And so we look at what the government's trying to do about this. And they're looking at things like income tax, obviously, as a significant source of revenue. They're saying everyone needs to pay money on the money they make. They're looking at FICA tax, which is, employers and employees have to contribute to a tax base beyond just your income tax in order to pay for some of these entitlement programs. Then we've got Social Security tax, means once we've given you the entitlement program, we're going to then take some of that back. It's effectively just a reduction of your Social Security. Then there's capital gains that says even if you've paid money, taxes on the money you've earned, but that money makes more money in some investment, then we have to tax the money that was made on the money that you already paid taxes on. And then we have sales tax, which is you go out and buy something at a restaurant or a store and you have to pay tax on the thing you purchased. We have property tax, which says you own something, so we have to tax you for owning that thing. And ultimately estate tax, which says if you die with something that you've already paid taxes on but want to give it away, we'll tax you again. So how does that feel?
Wow.
Feels pretty great, right?
Yeah, it does. It does. I wouldn't suggest this exercise, but I've gone through and I've thought, hey, if I aggregate all the taxes, not just the income tax, but the sales tax I pay throughout the year, the property tax, etc., what is the effective tax rate? And I wouldn't suggest that exercise.
Yeah, no,
it's not a healthy exercise.
It's pretty rough. So when all is said and done, what we're trying to look at here is on the Social Security portion specifically, we've got kind of two elements here. FICA taxes have historically continued to just go up, which means how much they charge us on the amount of money that is going back to the entitlement base. That number as a percentage continues to go up and has gone up for the last 80 years. And then the amount, the wage base that they'll base the FICA tax against has also gone up. So they can continue to control those two numbers. They can say what percentage that we need to take, and we're clocking it against a certain wage base. And both those numbers have continued to rise significantly, and this is how they're trying to come up with the amount of money they need to pay for the benefits that they've promised out on the entitlement programs. And so the issue is, in spite of all this, in spite of the FICA tax going up and the wage base going up, the latest trustee report indicates that we will have what they call the old age survivors insurance, OASI, which is the trust fund used for Social Security. And that's kind of not politically correct anymore, but that is the name, is the old age survivors insurance. That is scheduled to be, those benefits are not going to meet what has been promised, will not be supported by inflows in 2033. And so the tax base will not support it, and what's remaining in the trust fund will be depleted.
Yeah.
And so this is highly problematic. And so a lot of times people will come to me and they'll say, well, the Social Security, trust fund will be depleted, so my benefits are expected to be gone. And I'll get to that in a moment, but there are a lot of reform proposals that are floating around. I think one that is, quite simple is raising that payroll tax wage cap. So today it's at $176,000. And like I showed you that chart, it continues to go up, and they'll probably continue to raise that. And there's even proposals where they will eliminate it altogether and say every dollar you make, regardless of how much you make, will go towards the wage base. And others will create proposals that say, they'll reintroduce it after $400,000. So they'll have a wage cap at like 176. And then it'll kind of be like a donut hole, so to speak, where there'll be no other tax paid up to the $400,000 mark. So for the highest wage earners over $400,000, they would be adding an additional benefit from $400,000 beyond. So if they make $1 million, an extra $600,000 of wage base going towards their taxes. And they're not going to pay you more money on Social Security for that. That just is an extra contribution for the pool. They could increase payroll tax rates, which wouldn't surprise me either. There's conversations on doing kind of mixed revenue or benefit changes. That one would surprise me, just because I think the people that elect, and vote these people into power would probably revolt on that one. They could change the retirement age for people broadly. That one definitely, in my mind, is a lock. I'm 44 years old. My full retirement age is age 67. If anybody was born in, let's say, 1961, 19 years before me, their full retirement age is still age 67. When Social Security came out in 1935, the full retirement age was 65. So life expectancies back then were like 71. And today life expectancies are reaching into our 90s. So it wouldn't surprise me at all if they bump full retirement age to a level higher than that, and that wouldn't surprise me. They could change the cost of living adjustment. There's conversation about them doing that. And the one that is really interesting is the threat of introducing means testing, and where they'd say, hey, we might need to go in and say you make too much money or you have too many assets, you don't qualify for the benefit. And I don't see that happening either. Based on everything I've studied, I think these are just kind of fringe proposals that get talked about, but there's no traction. And to be clear, I want to be real clear about this. Every time we have this conversation on these calls, I get emails back from clients saying, when are these happening? There's no traction behind these proposals. These are all just being floated around by different, congressional committees that talk through these things, but nothing is, formally written or up for a vote right now.
Yeah. Well, and I think the events like this week underscore that, right? We're on the cusp of a government shutdown, and government inevitably waits till, the problem has already happened to solve said problem. And so I think we're of the mind, Paul, that, by 2033 or about that time, they'll have some solutions, maybe some of the things that you've outlined. But if government kind of follows suit with their track record, it'll probably be when the problem's already upon us. And I think it's interesting to think about, too, how we got here And you look at, I mean, and you alluded to one point, and that's the life expectancies, extending out significantly. And then the other thing is the huge demographic thing where we have a huge population base of baby boomers who are now leaving the workforce, so we don't have them contributing any longer to Social Security, and they will now be recipients of Social Security, and we have fewer workers to kind of backfill for that. And so that's kind of how we got here, and I'm of the mind that they will solve the problem. I don't imagine, Social Security, meeting its demise in 2033. I think that's, super hyperbolic, but I do think there will need to be some adjustments for it to continue to be solvent.
Yeah, I know. I'm totally with you, Scott. I'm not a doomsday guy. I know all that sounded like I'm doomsday, and I apologize for the the potential fear mongering there. I'm not a doomsday guy. I'm a pragmatist, and I look at Social Security and the program itself, and I think there's no way they're shutting that down, because today something like 2/3 of senior citizens rely wholly on Social Security to maintain their standard of living in retirement. So if they pulled that program out from underneath our aging demographic today, you would shift an entire population from Social Security to welfare.
Yeah.
And so as a pragmatist, it doesn't make any financial sense at all, because the administrative expense is worse under the Medicaid kind of welfare program than it is Social Security. And so it's still going to be a taxpayer's problem. They're going to find a way to make Social Security solvent, and it wouldn't be that complicated to do. A couple minor shifts that most people wouldn't feel significance to. For example, changing the full retirement age for a younger generation, and bumping that FICA tax cap to the donut hole conversation of $400,000. Those two things would make the program solvent for another 30, 40 years.
Yeah.
So I'm not worried about Social Security as a program being solvent. But when we talk about planning tips, we do have to consider what potential changes and reforms we have to analyze, because these things will likely be a reality for some people, and not necessarily for our clients that are right there at retirement window, but certainly for those that might be a decade, in ahead of that. And so there will be some adjustments that we have to consider. In our just a couple minutes we have left, I want to share some of these planning, two quick planning suggestions. Andrew, is my screen still being shared? Yes, perfect. So what we're going to do here, guys, is we're going to go right to this client. His name is John Sample. And if we look at the back page of our Social Security statement, they'll have an earnings history on the back page. So you'll have a couple pages on that statement. And the back page is the one that we like to look at. A lot of times people will like to look at the front page. We like to look at the back page. And we take all that earnings history. We can plug it into this software. And there's some pretty sophisticated details here. We can plug in a cost of living assumption. We can plug in kind of duration, when we think someone's going to live, tax rates, the percentage of benefits that are taxable, so on and so forth. And then the computer will run a calculation as to if this couple, John and Jane Sample, live to the expected mortality, then the computer says, okay, then they'll probably draw something like $2.5 million out of the benefit. And it gives us a breakdown. It says John should turn his benefit on at age 70. And then it says Jane should turn her benefit on at age 70. And as a result, if they live a long life expectancy, they'll get about $4.5 million. If they live an average life expectancy, about $2.5 million. If they live a young life expectancy, a little over $1 million. Well, the problem is the computer program will look at the math, and if we put in any reasonable life expectancy, it very consistently will tell people take the benefit out of the late age, because that is how the math tends to work. So what we want to do is show what's called a heat map. Okay. And in this heat map, we're saying there are some times when that won't actually play out to be correct. So in the heat map, what we're saying is this is our spouse life expectancy. So the older she lives, the younger, and then client life expectancy, the younger and the older. And if they live their life expectancy, green is saying that's when the primary strategy would in fact work. But there are times when turning it on at the full retirement age, so let's say, for example, the client lives to be 80 and spouse lives to be 79, then having drawn the benefit at their full retirement age would actually have proven to be a better benefit. And if they lived even earlier, let's say 75 and 77, then it would be better to take the benefit early. Okay. So the one thing that I want to show is what we call, there's another strategy out there that it's called the survivor maximizer strategy. And in the survivor maximizer strategy, we try to offer something unique here. We say, what if Jane, let's say in this case, contributed to the Social Security program and was eligible for her own benefit? And many people say, well, but her benefit won't be as significant as half of my benefit, so it's better off just to let her take the spousal benefit. But in this case, what if Jane turned her benefit on at 62, at the earliest she was eligible to turn her benefit on? And in this case, she drew $1,960 a month. And then John delayed his benefit to age 70. So he's going to get the delayed benefit for $5,315. And then at that point, Jane has the ability to, transfer to a spousal benefit. We call this the survivor maximizer, because in this version, if we go back to that heat map, the survivor maximizer option to the heat map, something interesting shows up here. So you see in this version, there are two outcomes where it actually would be significantly better to do the benefit the way we showed. If either spouse passes away before about the age 82, then it would be better to take the benefit the way we indicate. So the likelihood that both spouses live to their mid-80s is reasonable, but not extremely high. The likelihood that one spouse lives into their late 80s is extremely high. And so this is like a little bit of a hedge option that says, what if we took the benefit, one spouse takes it early, the other spouse takes it delayed, and now if either spouse does pass before age 82, we have the benefit of taking two benefits for an extended period of time, because once that first spouse passes, you're only going to get the one surviving benefit. And so this is a good option for a lot of people that I wanted to share. We call this the surviving maximizer. I think the big takeaway that I want to leave everyone with is, when it comes to Social Security, there are a lot of good strategies that need to be explored. We don't believe that just because the government's financial house might not be in perfect order, that the benefit is going to be defunct. And we think it is very valuable to take the time to examine all your options when it comes to how to, structure that benefit and ensure that you are entitled, that you're going to get what's rightfully entitled to you, that you've been paying into the system for 20 and 30 and 40 years. We want to maximize what you are rightfully entitled to. So, Scott, hopefully that was helpful.
Absolutely. Absolutely.
Yeah, appreciate all your insight on the markets. And we appreciate all of our clients jumping on here with us again for another month's edition of the AWA Market Minute. And everybody be safe out there. And until next time, take care.
Thanks.